So for more on how to make money in the space right now, we're joined by one of the most successful commodity traders of all time, Mark Fisher. He's the CEO of MBF Clearing. Fish, welcome back. It's good to see you today.
Hey, Scott. How are you?
I'm good, thanks. It's good to have you, given where we have been in the commodity space and where we may be going. I mentioned the kind of year that oil's already having. And let's take that part of the complex first. Are we going to $100? Is it a formality at this point? How do you see things?
Let me just comment one thing before we get to that, because of what you kind of said. What's interesting is when you talk about the commodity markets and trading, is that now all these intraday reversals that happen every other day in the futures markets are now starting to happen in the stock markets. You know, there's the NASDAQ reversals. So to me, what's interesting about what your panel just said is that what the commodity markets are starting to trade like the stock markets used to trade, where it's the buy the dip mentality, while the stock markets are trading like the commodity markets used to trade. And in terms of that, eventually, you know, oil is as long as we're trying to go ahead and replace dirty oil, you know, coal, oil, nat gas, with reliable, renewable energy, and yet we still have the supply differential where we're not going to be able to supply as much, and where companies like Exxon and BP have pledged to go carbon neutral and are spending much more of their capex on renewable energy and less on, you know, conventional energy. The handwriting's on the wall. Eventually, we're going to trade even higher. It's going to happen. Whether it's $100, $95, $110, I don't know, but overall, the pictures is we're going to go much higher
because of the supply-demand equation that you just said. I mean, what's your view? I know you must have a broader market view than just commodities. I know that's your acumen, and that's the principal thing you look at. But do you feel like we're in an environment of a major dislocation happening within the equity market because of where interest rates may go and these expectations of Fed policy?
Well, I don't really trade much equities because that's not what we do. But with the equity markets starting to trade like the futures markets do, it's a lot more attractive to us. But on that hand, think about this, okay? If the Fed wants to lower inflationary expectations, the government already tried that in the commodity markets unsuccessfully. I mean, the day that the administration announced the Strategic Reserve Initiative, since if you bought the market in crude oil, the market's rallied $20 within 5 minutes. That was the low. So if you really want to lower inflationary expectations, does the Fed want the next, 10% move in the equity and debt markets to be up or to be down? I don't know. That's a question for your panel, not for me. But I kind of think that you want to lower the froth in the market. You want to lower the real estate prices. You want to, cut off. Because remember, people trade on perception reality, not what really is reality in everything. So in order to affect inflationary expectations, which then affects eventually inflation, you need to cut off, you need to change the perception. They're not going to be able to do it in the futures markets. They're not going to be able to do it in the oil markets. They're not going to be able to do it in the grain markets. So it limits how much they can really, what they can really do. And I think that's why the paper markets are the ones that are being affected.